Hi, what's up everyone? Welcome back to Mr. Money Invest. In my last video, we talked about the Silicon Valley Bank, which almost triggered an industry-wide banking crisis. But that is just the tip of the iceberg. Whatever that has happened in the US, it has triggered investors around the world to be so worried about other banks as well, especially those weaker ones. In the end, it was a 5-word interview response from this gentleman here from Saudi Arabia that unleashed the fear in one of the world's largest bank, Credit Suisse. Wait. What does a Saudi Arabian got to do with Credit Suisse? To give you some context, last year, Credit Suisse was drowned in a series of corporate espionage scandal, the money laundering activities that was being alleged, private banking frauds, so on and so forth. Investors were losing confidence in Credit Suisse, and as a result of that, they withdrew billions of dollars away from Credit Suisse and put in other safer banks. It was bleeding so much that it got them into trouble. Lucky for them, Saudi National Bank came in to rescue and took up almost 10% of Credit Suisse shares and became one of the largest shareholder in the bank. Fast forward to 2023. Like what I've talked about in my last video, the US had its trouble in terms of banking crisis. Started with Silicon Valley Bank. That got people wonder. Credit Suisse is not a very safe bank. And if they got into trouble again this time round, would the largest shareholder come up and pump in more money to support Credit Suisse if it needs the liquidity from their shareholders? Unfortunately, this was his response. Investors are panicked that if the bank needed more funds to avoid a crisis, Saudi National Bank will not be there to provide that support, and that sent the share price down from 250 all the way down to 89 cents, which is a drop of 65% in the span of just a few days. In response to that, the Swiss Central Bank quickly came out and said, hey, come on, don't worry. We are here and we are ready to provide up to $50 billion of lifeline to Credit Suisse if they needed the money. And because of that, the shares of the Swiss bank gained 19% immediately, right? But investors are still not very confident with that measure, right? Analysts say that they remain wary about its prospect of Credit Suisse. So in order to regain confidence of Credit Suisse investors, the Swiss government had also invited Switzerland's largest bank, UBS, to acquire Credit Suisse. The objective here is to get a bigger bank that has a stronger balance sheet to take over all the burden of Credit Suisse, including all its debts, so that Credit Suisse can continue to operate normally with the support of UBS itself. But think about this, who would want to buy a bank which is in trouble right now, right? Nonetheless, as a gesture of national service, UBS did make an offer to acquire Credit Suisse at a price tag of $1 billion. But the question is this, at that point, Credit Suisse market cap was at $7 billion. So to buy Credit Suisse at the price tag of $1 billion, essentially it is an 86% discount compared to the market price. That's a bad deal for Credit Suisse shareholders. And it seems that Credit Suisse shareholders will never see light at the end of the tunnel anymore. That is until the Swiss government did something very unexpected. Now, in order to sweeten the takeover deal for Credit Suisse shareholders, FINMA, which is the Switzerland's authority, announced that they will write off 17 billion worth of borrowings off Credit Suisse balance sheet. Essentially, what that means is that when UBS buys over Credit Suisse, it does not need to pay back a single cent to Credit Suisse lenders. Since there will be less debt for UBS to pay right now when they acquire Credit Suisse, now they don't mind to up the price from 1 billion that we mentioned just now to 3.2 billion. That sounds like a happy ending, only that it's not. Now, this is because the 17 billion that FINMA write off is also investors' money, right? In a form of borrowings under this instrument called AT1 bonds. Now, this instrument is introduced after the 2008 subprime mortgage crisis to help banks to build stronger liquidity in the event of a crisis. The idea during that time was that banks should go out and source for their own emergency funds by issuing and selling AT1 bonds to the market so that the government doesn't need to fork out taxpayers' money money to bail out all these banks, which makes a lot of people unhappy. Now, the beauty of AT1 bond is that in the event that a bank cannot repay these bonds, they can actually convert these bonds into equity, become shares. And this means that by converting these bondholders into shareholders, the banks will not need to repay those borrowings anymore. And that will lighten the financial burden of those banks. But what FINMA and Credit Suisse did was, instead of converting AT1 bonds into equity, they just write it off. UBS didn't need to pay a single cent, and all these bondholders were not converted into shareholders. And this got investors very confused on what's going on. Did they misunderstood the product? Whatever it is, the first reaction was to sell any other AT1 bonds that they own in other European banks, and that triggered a major sell-off of AT1 bonds in the entire Europe market. As a result of this major sell-off of AT1 bonds, the bond yield shot up to a record high. Now, what is the implication? It means that the investors of AT1 bonds have already lost confidence in the instrument, and if European banks still try to sell AT1 bonds to raise funds, but this time investors would require the banks to pay a whooping 15.36% return in order to entice them to invest in that product. But more importantly, by writing off the 17 billion Credit Suisse AT1 bonds, not only going forward European banks will find it much more difficult to raise money, FINMA had actually disrupted the fundamental knowledge of banking. Now, investors are very confused because under normal circumstances, this is the normal hierarchy of a capital structure. When a bank faces a crisis and needs to be liquidated, whatever money that is raised needs to be paid out to the depositors first, followed by the senior debt holders, the AT1 bonds, and if there are any money left after paying all these people, then only the money will be given back to shareholders. As a result of that, as you can see over here, depositors will usually take the lowest risk in a capital structure, and shareholders will always hold the highest risk in any investments. It's kind of like if you own a nasi lemak store and you borrow money from your parents to open that store. So if you decided to wind out the business, the first person that you need to pay is your parents, and only if there's any money left, you can pocket the money yourself. But when FINMA decided to write off Credit Suisse AT1 bonds and sweeten the deal for Credit Suisse shareholders, essentially what it did was to disrupt the entire capital structure of the banking system. Anyways, as for the shareholders of Credit Suisse, since UBS is willing to pay 3.2 times higher the price, they are very happy. In fact, the biggest winner in this exercise is Saudi National Bank, because they are the largest shareholder of Credit Suisse, owning almost 10% share in the bank. But that begs the question, did the Swiss authorities do that in order to salvage the relationship with Saudi Arabia? So much so that they are willing to change the rule of the game in the banking system. Because of that, Credit Suisse AT1 investors are very angry, and they are prepared a lawsuit to go against Credit Suisse and the authorities for this 17 billion bond write-down. The thing is that even if they choose to do that, it's gonna be a long process. In the meantime, the truth is, whatever that has been invested in this instrument, it's considered all gone. All I can say is that at abnormal times, people in power have to use abnormal measures to counter the situation. We are in a very turbulent economic conditions right now, and people in power are trying their very best to contain the damage so that it doesn't spill over to become a global financial crisis. On the personal finance level, I've heard people investing all their life saving in Credit Suisse AT1 bonds, and it must have been catastrophic for them seeing all the money disappear overnight. These stories tells us that no matter what investments that we put into, even though we think that it is the safest possible assets, diversification is the key in order to sleep soundly at night. Now, what do you think about FINMA's decision to write down the 17 billion Credit Suisse bonds? Do you think it is justifiable? Tell us in the comments below. And don't forget to like, subscribe, share, and turn on the notification bell, and see you in my next video.